Pre-money versus post-money valuation is one of the weirdest terms that you'll have to deal with as you navigate your fundraising. It almost looks deliberately designed to confuse you and screw you, but I genuinely think it's not. The reality is that both of these terms are important and used for different critical calculations your business needs to run. So let's get to it. This episode is brought to you by the Made in China app, the go-to app for international trade. For more information, click the link in the description. The first concept that your business needs to grasp is how shares are issued. We are accustomed to thinking of company ownership as percentages. I'm giving 10% to this investor, and the founders are keeping 30% each for themselves. But what if a new investor comes in? Who does that 10% come from? Whose end does it come from? Well, understanding company ownership in percentages is simple, but the reality is that it's not how things work in real life. Splitting and distributing shares. Well, LLCs do operate on percentage ownership. C corporations, which are the most traditional type of business structure, especially in the startup world, work with shares of stock. When a company is founded, it creates a bucket of shares, and a share is a fraction of this company. So yes, you could have a company that only has one share, or 3 shares, which is simple but unpractical. The problem with that approach is that it's tough to split the ownership of a company if the number of shares is so tiny. So it's pretty standard when corporations get established that the number of shares is set to 1 million or maybe 10 million. We incorporated Slidebean with 10 million shares. So our cap table is a bit more complex than this, but for the sake of example, let's assume that we split the company 3 ways. So that would be 3,333,333 shares for each one of the founders. Well, there's a problem there, and that's a weird number of shares, and then there's a single share that we can't split because shares can't be fractional. So one solution would be just to give someone an extra share. If you have 10 million shares, having 1 extra shares is not really that much extra value. Another alternative would be to establish the company with a number of shares that's divisible by 3, like 9 million. That gives us around 3 million shares for each one of the founders, which is pretty good and round. So the percentage ownership is 3 million divided by 9 million, which gives us 33.33333. Bringing an investor. Now, a key point to understand here is that shares don't usually exchange hands, except if the company is getting sold or acquired. In a typical scenario, the number of shares a partner owns is never going to change. Founders don't give or sell shares to the investors. Instead, the company will issue new shares when it needs to. And that's where valuations come in. How many shares does this investor get, and therefore, what percentage of the company do they get? In more traditional companies, this investment transaction is based on how much the company is worth. So the value of the company can be calculated by the assets that they own, the revenue that they generate, their EBITDA, which is earnings before taxes, or a combination of those 3. And then the term becomes very clear and straightforward. Pre-money valuation. How much is the company worth before the investor comes in? So let's say that a company is making $500,000 a year in revenue, and that revenue is growing at 20% year on year with a 25% margin, so about $125,000 in EBITDA. An investor could come in and say that the company is worth 1x or 2x revenue, so $1 million. If they wanted to invest, say, $250,000, based on that 1 million pre-money valuation, then the company's post-money valuation would be $1,250,000. The pre-money valuation plus the new cap. Now, considering that scenario, since the investor provided $250,000 of the $1.25 million that the company is worth now, their corresponding share is 20%. That's the investment divided by the post-money valuation, not the pre-money valuation. So once again, where does the 20% come from? The founders won't be selling their shares. On the contrary, the company will be issuing new shares. So in this scenario, the company will need to issue new stock for the investor. Assuming this company is this theoretical Slidebean that had 9 million shares, then the basic rule of 3 would tell us that 9 million, which now represent 80% of the company, then 20% of the company is represented in 2,250,000 shares of stock. So the company will need to issue these 2,250,000 shares to the investor. And after that, each one of the founders will continue to hold 3 million shares, but they will no longer represent 33% of the company, since the company now has 11,250,000 issued shares of stock. The 3 million shares each founder owns now represent about 26.6% of the company. The number of shares they own is the same. What changed is the percentage of equity that they represent. So once again, pre-money valuation plus investment equals post-money valuation. Now, if you don't want to crack your head at this, our financial model has a little funding estimation sheet tool that you can use to get this calculated for you. It's free to download. I'm going to link it in the description. Startup valuations. In that particular example, we used a valuation that was based on some tangible data, revenue, assets, growth. On early and seed stage startups though, valuations can't be calculated based on anything. So the whole investment and shares exchange becomes a negotiation game, and that's why you essentially see a large range of valuations that may sound unjustified. In the end, that valuation is just a reflection of how excited investors are about the company, how much capital the company needs, and how much upside they expect, how much success they expect from the company. If many investors want to come in, or if the company is in a very hot space, founders might literally get competing term sheets between different investors, pick the best valuation, or then use that term sheet to negotiate better terms with the other investors. Clubhouse reportedly raised a Series C round on a $4 billion valuation, pre-revenue. Their founders are obviously good at this. When an investor considers what stake in the company they expect in exchange for the risk they're taking, they're asking themselves, what could eventually happen to this company? If this is a company that could become a unicorn and go public, then investors might consider a smaller stake because the upside is still huge. On the other hand, if the expectation is that this company will get acquired for $200 million or less, then investors need to be much more careful about these valuations. I had this chat with Paul Silva the other day on how they value investments at his angel group.
If you are going to be breeding unicorns, that means you're not super sensitive about the valuation of the companies at the beginning. So getting the terms conservative and right at the beginning really, really matters. You cannot screw that up. Off by a factor or two will totally ruin your return on investment.
Either way, it's a negotiation on upside versus risk. So just like the odds on your favorite gambling website. Traditionally, a seed round for a startup will be in the range of $500,000 to $2 million and should translate in 10 to 20% stake in the business. So let's translate those ranges into pre-money and post-money valuation. In the lower range, $500,000 for 20% of the business would mean that the entire company was valued at $2 million pre-money. Post-money, it's $2.5 million, where $500,000 represents 20%. On the higher range, $2 million for 10% of the business, that would mean that the company was valued at $18 million pre-money. Post-money, it's $20 million, where $2 million represents 10%. As far as I've seen in my experience, investors will use either term on a term sheet, and you just have to be careful and understand what each one of those means. On the $500,000 investment example, we saw a $2 million pre-money valuation translated into a 20% equity stake. If we use $2 million as the post-money valuation, then the stake becomes 25% instead. Share price. So the share price is not particularly relevant at this stage, but as a reference, the share price is calculated based on the pre-money valuation. So let's go back to the Slidebean example. Again, 9 million shares for the founders, $250,000 investment, 2,250,000 shares were issued to the investors for a 20% stake in the business. Now, the share price for this company is estimated using the pre-money valuation, which was $1 million. So it's $1 million divided by 9 million shares for an effective 0.11 price per share. The investors bought 2,250,000 shares that were issued for them. So we can also confirm that $250,000 divided by the 2,250,000 shares that they bought gives us the same 0.11 price per share. Share price is not really that relevant at this point, but it does become really important when the company gets acquired or when you're issuing stock options for your employees. Other investment mechanisms. Valuing a company with no revenue can be really too arbitrary, so other approaches to raising money, such as convertible notes and safes, have been invented. We have some content about them. We have a full video explaining how convertible notes work, so go ahead and check that out. We also did this 4-episode series on a startup story from inception to exit, including examples of a founder leaving and vesting and multiple rounds of funding. I love making these videos when I share some of my experiences in the startup world, and I also love to take the opportunity to highlight new products and apps that we've used recently, like Made in China. I stumbled upon this app while helping a startup put together a pitch deck and a financial model. They mentioned that they used Made in China to source high-quality products at reasonable prices. So I downloaded the app and found this huge selection of reliable Chinese suppliers with some real reviews at competitive prices. It's easy to understand and it gives you information about more than 40 million products of more than 27 industries. And then the app verifies suppliers to guarantee quality and reliability. So you can manage orders from anywhere in the world with just your mobile phone. For more information, you can click the link in the description or scan the QR code on the screen. Enjoy thousands of top product categories and get free coupons to bring your business ideas to life. Thanks to those guys for sponsoring today's video. Hope you enjoyed it. Hope you found it useful. Let us know in the comments, and we'll see you next week.